You're a savvy investor. You don't care where interest rates are. You take where the debt is and see what happens and see if you can make money at current debt levels. If you can't, pass on the deal. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this important lesson, we're going to be discussing navigating interest rate changes with your multifamily portfolio. You're hearing rates are going down. Are they going to stay? Well, how does that affect your portfolio now? And how does that affect deal flow going forward? That's what we're going to be discussing on this lesson, on this how-to this week, because it's one of the most, for me, interesting discussions that we've had over the past 2 years. In 2022, we look back, and that's where we can find out that multifamily peaked. That's when valuations peaked. Since then, they're down about 20%. I would say they should probably be down a little bit more, but right now, everyone's at a hold pattern. And what's really interesting, I want you to listen to this number, $2.8 trillion. That is the loan maturity by the year 2028. That's the amount of loans that are maturing by 2028. And we heard all of the doom and gloom last year that we had so much interest rates. That means we had so many loans coming due, especially in October of last year and in October of this year. But what's happened is people have bought cap rates and they've extended, and they're just praying that rates go down. Now, we talk about buy right, manage right, and finance right for a reason. Finance right component, as I've been in this business for almost over 2 decades, I've really realized and come to appreciate how important financing is. We own property in Italy. My mom built this beautiful home back in 1996. I went to go look at it. I never saw so much concrete going into a single family residence in my entire life. All the steel. They built this roof, terracotta. The guy took over 2 months just to do the roof. He laid them hand by hand. It was just amazing, the process. And why do they do that? I thought they were nuts. But now looking back, my mom, her town had an earthquake back in 2009. Nothing happened to her house. It was truly amazing. To be able to build a house like that today, I would venture to say it's going to cost at least $1 million US dollars because of all of the furniture, the fixtures, the cement, like I said, the roof, the land. And yet in Italy, it's very difficult to get a mortgage. The financing is very challenging. If you don't have cash to buy the deal, you don't buy the deal. You have to save and save and save. And what does that do to real estate prices and values? It really suppresses the values because there's less demand. If your house is worth $1 million, you know it's worth $1 million, but there's nobody out there that can get a mortgage for it. I'd venture to say my mom's house, luckily, if she can get $300,000 in US dollars or 300,000 euros, right around there, I think she'd be fortunate. And it's really, I think to me, a component of the financing where they don't just give bank, they don't give loans out in Italy. Very difficult to get a mortgage on a property. And as you can see here back in 2022, the frenzy that was going on with all this bridge debt, interest rates were really low. And I'm going to give you this other stat. At $5 million, if you have a loan at 3.5%, the mortgage payments are $22,000 a month. Write that down. Just take a look at these numbers. It'll blow your mind. At 7%, that payment is $33,000. At 6%, it's $30,000. So right now, let's say rates are at 7% right now. So you're back in 2022, you're doing a deal at a $5 million loan at 3.5%. Your payments are $22,000 a month. You're paying $11,000 more per month at the current interest rate environment. That's $111,000. That's like $130,000 a year more just in debt service. So logically, rationally, what should that do to pricing? Pricing should come down, and it has come down. But to my, taste, or to what I like to see, I think it should come down even more. And I think that's where we are right now. But the Fed is what we call in a pickle right now. And why are they in a pickle? Because the debt payments right now are surpassing $1 trillion just on interest from these high rates. They need to drop the rates. But if they drop the rates, inflation's not going bye-bye. We still have a ton of money sitting on the sidelines. And when rates do drop, there are a lot of deals out there. And I would venture to say some of those deals should probably go into foreclosure or should probably lose money and get wiped out and should probably get sold at a loss. They may be able to refinance at that lower rate. So it's very interesting navigating these lower rates. What do you do as a buyer? Well, listen, we've just closed 2 deals in the last 2 months. There are deals out there. You just need to be on brokers' lists. You just need to be the first or second person to see that deal. It's much more challenging to get debt right now because debt is starting to pull back, and it has. We've been using credit unions for our deals because the community banks have been more challenging. Their rates are a lot higher. Credit unions, they may be a little bit more challenging to work with on the front end. They want more paperwork. They really disclose. They really look at that deal really well. They've done a good job underwriting our deals. But at the same time, the rates are much better, much lower than a community bank. And we got interest only on these deals. And we've got a 5-year term. So we don't like this 24, 36-month short term because we don't know, where rates are, especially 2 years ago when rates were so low. And what's important right now, the deals that are getting done. We're getting a lot of deals getting done now that are assumptions because when debt was 3.5%, you see where it is. And now if you can come with a supplemental loan when you do an assumption, that's pretty cool because you can get some more of your own debt and get interest only. The problem with an assumption is you don't get that interest only period. And then you only have 6 or 7 years left on that loan. But if you're buying it for a good price and the debt's in place, depending on how much capital you got to bring in, that's one way you're going to be able to navigate these rates. If rates still stay where they are, assumptions are still going to be very attractive as rates start to go down. And that's my fear. My fear for the economy is you have all this money sitting on the sidelines. Residential is slowed down tremendously. There's people out there that have, I bought a home back in 2021. My rate on that home was 3%. Mortgage payment was X. Now you can see if you do the same thing that I just did with a $5 million loan. Do it with a $500,000 loan. You'll see the jump in payments from a 3% mortgage rate to a 7% mortgage rate. It's I don't use the word staggering, but it is substantial. So if I've got that loan at 3% right now, and I've got to go buy another house, but I've got to buy a house at 7 and give up my 3, it's not going to feel good. And that's what's going on with residential. Deals are just sitting there. And prices are still too high. People are still thinking they're back in 2022, 2023, when the broker told them, yeah, you can get $700,000 for this house. You know what? You can't at a 7% interest rate. Now, those people who are savvy or ones who really have that long-term mindset, they're underwriting a deal. They may be overpaying a little bit on the front end today, but they know that rates are going to drop sometime in the future. If they can make the deal work at this, I don't want to call it higher interest rate environment because traditionally, that's where rates have been. I mean, on average over the last 100 years, they've been around 6.5%, 7%. That's what the average is. We've just been so used to low interest rates. So if you can buy a deal today and make it work at 6.75% or 7% and you're cash flowing, can you imagine when rates do drop and you have this deal stabilized, you're able to go and refinance that property? Now, I would not go out and buy a deal today with a negative cash flow if there's no possibility with my pro forma to be able to get that to a positive cash flow. I'm not buying a deal that doesn't make sense if I can, repurpose the deal and keep the same interest rate at 6.75%. Let me make that clear. I'm not buying a deal and saying, hey, I'm buying this deal. It doesn't work now, but I know in 18 months from now, the rates are going to be at 4. So it'll work when I refinance it at 4 when I push up the values. That's not what I'm saying. Make the deal work in today's interest rate environment. If and when rates do drop, then that's the icing on the cake. And listen, they're going to have to drop. It's part of the interest rate cycle. They're stuck because they know they raised them so quickly. I mean, it was a record at how quickly they raised them. They shocked the system. Everything went dormant. I mean, for multifamily, I think activity's down over 60% from last year. Hopefully, by the end of this year, I think there's going to be some of these assets that banks want to get off their balance sheet, and they're going to actually put them out, and they're going to sell them at a discount. That's what I'm thinking right now. But when you're seeing that activity's down 60%, they have to do something to spur this economy. You saw the jobs report come out. They overestimated jobs by 800,000, so jobs are basically flat. That's insane. Think about that. So they know right now the one lever they can push to spur this economy is by dropping rates. But if they drop rates, then what happens to inflation? And inflation is just an increase in the supply of money. The cause effect of an increase in the supply of money is what? Higher prices. So when these rates drop from 6.75%, 6 back down to 4.5%, what happens? There are groups like Jake and Gino that can go there and refinance their properties out. They're going to pull additional capital out. They're going to get more money into the economy. And then when rates drop, things get cheaper. What happens with all these groups that have money on the sidelines? They're going to jump back in. There's going to be more demand. There's going to be more bid up for pricing. So for you listening to this right now, it's a good thing that you're listening to this because there's a window. right now. They haven't raised rates. They haven't dropped rates yet. There's an opportunity right now to go out there and network with the brokers, get on their lists, because there's not a lot of opportunities right this second, but there will be in the next 6 to 12 months. As debt cannot get extended by these banks, as they start calling these loans, there are going to be motivated sellers out there. I mean, guessing on what happens with this election, if the Democrats get elected, not really good for real estate. Their policies just don't work well for real estate. So if that happens, there's going to be a lot of motivated sellers. They're thinking about their capital gains, what can happen. So what I want you to think about, just put interest rates aside. You're a savvy investor. You don't care where interest rates are. You take where the debt is and see what happens and see if you can make money at current debt levels. If you can't, pass on the deal. But if you can, and you can stabilize this asset in the next 12 to 18 months and then refinance out lower, wow, that would be amazing. Now, what I want you to do is down below, if you're listening to this on YouTube, just leave me a comment or a question. I want to know what you're doing right now in this interest rate environment. Are you going out there? Are you still looking for deals? Are you on the sidelines waiting for interest rates to drop? Listen, I see all these memes out there with Warren Buffett. He just sold more Bank of America shares. What is he sitting on? $270 billion of cash? I mean, what does that tell you? He's waiting for the opportunity. He's waiting for pricing to drop. He's waiting for blood in the streets. He hasn't seen it yet. I guess that's a good thing if you're listening to this and you haven't bought any deals or you're waiting on the sidelines as well. Because if you're doing what Warren Buffett's doing, you're in very good company. So down below, questions, comments, leave them. I'd love to know what you're doing. And if you like the video, give me a like. Give me a big thumbs up. And I want you to subscribe to the Jake and Gino channel on YouTube. Every week, we're putting out new content, new how-to videos. We have a weekly Jake and Gino podcast as well. We have the Movers and Shakers, where our students are closing deals. Subscribe to the channel. We put out fresh new content 3 to 4 times weekly. And I love talking about multifamily. And I'm just so thankful and I'm grateful for you to be part of this Jake and Gino community. And if you ever want to get any kind of information, just go to jakeandgino.com. You can go to /apply. You want to work with our team, see how it is to work with the Jake and Gino team, how to become part of the community at that mentorship level. We'll love to have you part of it. One last thing that I want to mention to you. October 25th, 26th, and 27th, we're having our 3-day event in Denver. If you want more information, email me, gino@jakeandgino.com, or just go to the website. There's more information there. And don't let interest rates scare you. I want you to take the long-term approach on this. They're going to drop sooner or later. When they do, are you positioned to take advantage of the drop? Thanks again for spending part of your day with me, and I'll see you on next week's How To. Take care. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.